Good morning everyone. Today I am here to take a topic on depreciation accounting. It's somewhat a quite easy topic, and now we are going to see what is the meaning of depreciation, what are the causes, what are the methods, and what are the accounting treatments under depreciation. Okay, first let me tell you what is the meaning of depreciation, and then we will move on to the other concepts. Depreciation is generally charged on fixed assets of a business. So whenever a business purchases a fixed asset, an asset will keep on decreasing. So whenever an asset, for example, it may be a machinery, land and building, or machines, or whatever, furniture, or whatever it may be. So whenever it is purchased for the first time, it continuously decreases. So that decrease in the value of a fixed asset is said to be as depreciation. So the depreciation, let me tell you what is the meaning of it. A depreciation is permanent decline in the value of an asset. So as I told you earlier, permanent decline. So it keep on decreasing, it will be decreasing. And the gradual decrease both in the value and usefulness of an asset due to its nature and usage is termed as depreciation. So generally an asset cannot be used as it is purchased for the first time. Why? Because it may cause it may have many reasons, like we use it every year, we use it every time, and it causes some damages, or it may be due to passage of time, or even though it is used or it is not used, the value will keep on decreasing. So that decreased value of an asset is said to be as depreciation. Now we will see what are the causes of depreciation, or what are the reasons that leads to depreciation. The first one is use. That is wear and tear. So whenever an asset is used, it won't remain same, or it won't remain, it won't be consistent. Say for example, when a furniture is purchased, it may have some scratches after the prolonged usages. So that may lead to depreciation. That is the first reason. The second one is lapse of time. So there are certain assets where there is an expiration period for the asset. For example, the intangible assets like lease, copyright and patent, these are the assets where there will be an expiration period. So after the expiration period, it will not be used. So we have to renew it. Another example, take an example of a medicine. So a medicine has an expiration period. So after the expiration period, we cannot use it. So that may also lead to depreciation. And the next one is obsolescence. Obsolescence is what? Loss of usefulness. That means when an asset becomes an outdated. For example, when we purchase mobile phones, due to the newer versions or a technological updated, what happens is the older one becomes an outdated which cannot be used. So that may also lead to depreciation. And the next one is accidents. So when a goods or when stocks are being placed in godowns or warehouses, we may have some damages for the goods. So that also leads to this depreciation. The next one is disuse or remaining idle. Without using an asset also leads to depreciation. For example, the farmers where the equipments are used, that equipments will remain idle. They will use it only when the use comes. Otherwise, it remains idle. So that may also lead to depreciation. Okay. And the next one is depletion. Depletion is, there are certain natural resources like oil, gas, coal, mines and quarries where these assets will be exhausted because of its nature. That also leads to the depreciation. Now we will move on to the next slide. The methods of providing depreciation, that is what are the accounting treatments, or in what ways the depreciation amount is being calculated for each and every asset, that we will see one by one. So totally we have 9 methods of providing depreciation. First we will see the straight line method, which is otherwise known as fixed installment method or original cost method. The second one is diminishing balance method or reducing installment method or written down value method. The third one is annuity method, and the fourth one is depreciation fund or sinking fund method, and insurance policy method, revaluation method, depletion or output method, and the last one is machine or rate method. According to your syllabus, we will see the first 4 methods of depreciation. The first one, that is the straight line method. As the name says, straight line method, a uniform amount of depreciation will be charged year after year. So that is what straight line method says. and it is calculated on the cost price of the machine. So that is why it's said to be as original cost method. Why? Because the cash original cost, only in original cost the depreciation amount is calculated, and it remains same throughout the year. It never changes. The second type is the written down value method. As it says, written down value method, every year the depreciation amount will be reduced. Why? Because it is calculated on the book value of an asset. So that is written down value of an asset is calculated. So that is why it is said to be as reducing balance method. And the third one is annuity method. Annuity method, as the name says, it is based on the it is calculated on the annuity table. On that the depreciation amount is calculated. And the fourth one is depreciation fund method. So it is treated as a investment. Whenever an amount is invested somewhere else, we will get an interest. So based on that, we will calculate the depreciation amount under sinking fund method. So these are the four methods where we'll where we'll be using it in in syllabus. These are the portions they are covering it. Okay, so first we'll see the straight line method. The formula which is being used to calculate the depreciation amount and the rate of depreciation under straight line method is somewhat like this. The first one, depreciation. Depreciation is equal to cost of fixed asset minus estimated scrap value, which is divided by number of years of expected life. So cost of the fixed asset is the original cost of the asset, which is being subtracted by, which is subtracted with estimated scrap value, that is the residual value of an asset, which is divided by number of years of expected life, that is the useful life of an asset. That gives the depreciation amount. And next, rate of depreciation. The rate of depreciation formula is depreciation divided by original cost of plant multiplied by 100, which gives you the rate. Next, we will see a simple problem for calculating the amount of depreciation and rate of depreciation. Let me read out the problem and explain you in detail. A company purchased a plant of rupees 50,000. So 50,000 they have purchased a plant, which is the original price of an asset. The useful life of the plant is 10 years and the residual value is rupees 10,000. So the useful life, the estimated value of an asset is said to be as 10 years, where only for 10 years the asset can be used, and the scrap value or the residual value is rupees 10,000. Let me tell you what is the meaning of residual value or the scrap value, which means whenever you are purchasing an asset, for example 1 lakh rupees, it is said to be used for 10 years. So after usage of 10 years, we may not sell the asset for same 1 lakh. What happens is it will go for, say for instance, 10,000 or 20,000. So that value is said to be as the residual value or the scrap value. So that is what given as 10,000 for the asset value of 50,000. Now find out the rate of depreciation under the straight line method. So the formula is simple. The other informations are given. Just we need to apply the formula with the given information. First, amount of depreciation, cost of the asset minus estimated scrap value divided by number of years of expected life. Cost of the asset is given as 50,000 minus estimated scrap value is 10,000 divided by 10. So the amount of depreciation will be 4,000. Then we have to apply the rate of depreciation formula. The formula is depreciation divided by original cost of the plant multiplied by 100. So depreciation, which we have calculated as rupees 4,000, which is divided by 50,000, which is the original cost, multiplied by 100, will give you the rate as 8%. So this is a simple problem. Next we will see what are the basic journal entries to be followed under this thing. When an asset is purchased, first entry to be followed is when an asset is purchased, asset account debited to cash or bank account. So when a asset account, when a fixed asset comes into the business, asset and cash both are treated as, both will come under real account. So the real account rule has to be followed. When an asset comes inside, it has to be debited. For instance, we are paying cash for the asset, which that goes out. So cash account has to be credited. So asset account is debited to cash or bank account. The second entry is depreciation, which has been charged on the asset. So whenever depreciation is charged on asset, the asset value will be decreased. So when an asset value increases, asset has to be debited. When an asset value decreases, an asset has to be credited. So the entry is depreciation account debited to asset. Depreciation is in accounting, in profit and loss account, we will be showing it in the debit side, that is treated as an expense or a loss. That is why depreciation account is debited, as it is a loss to a business. And as the asset value decreases due to depreciation, the asset has been credited. So depreciation account debited to asset account. And then as depreciation is considered as a loss to a business, it has to be immediately transferred to the profit and loss account. The third entry is profit and loss account debited to depreciation account. So as the depreciation comes on the debit side of profit and loss account, so it has to be credited in the journal entry. Profit and loss account debited to depreciation. And the next one is when an asset is sold. An asset is sold, the asset goes out of the business, cash comes in. So bank or cash account debited to asset account. And then whenever we are making a sale, we will get either profit or loss. When we are getting lost, the entry is profit and loss account debited to asset. The reverse entry has to be followed for the profit, that is asset account debited to profit and loss account. So the three entries, that is the depreciation entry, transfer entry, that is profit and loss account entry, and these are the two entries which has to be continued year after year. The first purchase entry will come in the first year, and the sale entry will come only when the asset is sold. And then when the profit or loss there occurs, the last entry will come. Then we will see a problem under that is to be followed with journals and ledgers. So let me read out the problem and then explain it. Mr. S purchased second-hand machine for rupees 8,000 on 1st April 1990. He spent rupees 3,500 on its installation. Depreciation is written off at 10% per annum on the original cost. On 30th June 1993, the machine was found to be unsuitable and sold for rupees 6,500. Prepare the machine account for 1990 to 1993, assuming that the accounts are closed on 31st December every year. See here, in this case, the business has been, they have purchased an asset, the second hand machine for rupees 8,000, that is the original cost of an asset. It is purchased on 1st April 1990, and its installation cost. For installing that asset, it costs rupees 3,500. So the total value of an asset has to be considered as 8,000 plus 3,500, that is 11,500. It includes all the costs. And then the depreciation percentage is 10%, which is on original cost. As it's mentioned on original cost, which means we have to follow the fixed installment method or a straight line method. Then on 30th June 93, the machine was found to be unsuitable and sold. The same machine which has purchased on 1990 was sold on June 1993. That is, after using for 3 years, the machine has been sold for rupees 6,500. Now we have to open the machine account for 3 years. That is, we have to open the journal entry for 3 years. Before opening it, we'll see the working notes, how to calculate the depreciation amount for each and every year. We'll see that one by one. First, cost of machine, 8,000 plus installation cost 3,500, which was purchased on 1st April 1990. Put the date on each and every year, 11,500. Now subtract the depreciation for the first year. Depreciation amount has to be calculated on the year end. So the year end for this is the accounts are closed on 31st December every year. That means they are following a calendar year, that is starting from Jan to December. So the accounts are closed on 31st December. But the machine has been purchased on 1st April. So you have to calculate the number of months which has been used. So it is purchased on 1st April and it is used till 31st December. So the number of months has been 9 months. So we have to calculate the depreciation amount only for 9 months. So apply the formula, 11,500 into 10 by 100 multiplied by 9 by 12. 10% is the rate of depreciation, and for 9 months we have used, so 9 by 12. So we will give you the depreciation amount as 863 for the first year. Now subtract it from the 11,500, you will get 10,063, that is the book value. Next is the second year depreciation. Now for the second year depreciation, we have to calculate on the original cost, not on the book value. As it is based on straight line method, we have to calculate on 11,500. Apply 10%, you will get 1,150. Now subtract from the 10,063, we will get 9,487 as a book value. Now coming to third year. Now third year depreciation, 11,500, again 10%, will get 1,150. Now subtract it, you will get 8,337. Now again you have to calculate for the year 93. For the 93, we are using it only for 6 months. So apply for 6 months. So we will get an amount of depreciation as 575. Now subtract it, you will get the book value 7,762. The machine has been sold on 30th June 93. So for how much we are making a sale? 6,500, but the book value is 7,762, which means we have got a loss on asset. If the sale has been made above 7,000 rupees, that is 7,762, which is considered as a profit. but it is below that amount which is considered as a loss. So we have a loss of 1262. So based on this working notes, we are going to frame the journals. So we'll directly move on to the ledger. So ledger, first one is a debit side. So debit side, whenever you are purchasing an asset, asset account is debited to bank. So to bank 11,500 on 1st April 90, and the first year depreciation 863, which is there in the working notes, and then the balance carried on for the first year is 10,063. Then transfer it to the next year, which becomes a brought on balance for the next second year 10,063, and then second year depreciation. So second year depreciation is again 1,150, which is applied on 11,500. Then comes the third year, and then comes the last year. Now in the last year, after posting the depreciation entry, we have to post the entry for sale and then the loss entry. So this is what the ledger which has been prepared for this sum. So that's all. So thank you so much.